My name is Kjetil Storsletten. I'm the president of the European Economic Association. It's my honor to welcome you here today to Manchester, the cradle of the Industrial Revolution. As economists, it's almost like being on holy ground. I have to say, I would like to start by thanking the local organizing committee for the excellent work they've done and for being willing to host us here. And we really appreciate, especially the nice weather, I must say. Today, we're going to see a very exciting plenary talk by Veronica Guerrieri. But before we do that, we will award some prizes. The UniCredit Foundation has kindly agreed to award a prize for the best 3 papers at the conference presented by young economists. And young, to me, I must say, I feel everybody under 50 is pretty young, but the UniCredit has a different view. So being young means you must be under 30. All authors must be under 30, and you cannot have been more than 3 years since your PhD. So the 3 winners are most likely in our audience today. They don't know it, whether they have won or not. So, first I'd like to, before announcing their names, I'd like to invite UniCredit to step forward. And I would like to take the occasion to thank UniCredit for their generous funding of these important prizes.
Many thanks, Kjetil. We are proud to be here, and I just want to thank all the European Economic Association for hosting our award, and this is the 4th time, and I hope we can continue in the future. Many thanks, Kjetil, and many thanks to the European Economic Association.
So the way I will proceed now, I will read out the names of the 3 winners. They will hopefully step forward here, and then I will give a motivation when they are presented with their diplomas. So they are all winners on equal ground. I will present them in alphabetical order. First one is Giulia Giuppone. Giulia, are you here? Okay. So you should hold it a little because we're gonna. Okay, you perhaps. Yeah. I will do this. Please present them and give the. Let me read the motivation for her paper, When Income Effects Are Large, Labor Supply Responses and the Value of Welfare Transfers. So what Julia has done is to provide a very novel and interesting estimate of income effects in an important but special but novel empirical setting. She studies a reform of survivor pension in Italy, where there was a particular cutoff date in 1995, where those who died before 95, the survivor will get different benefits than for those who died after. So exploiting that regression discontinuity design, Julia estimates large and precise income effects that almost fully offset the lifetime loss in benefits, consistent with the sizable valuation of welfare transfers in widowhood. The estimated income effects are large, in part driven by delayed retirement of women who are employed at the time of widowhood and therefore face minor optimization frictions in adjusting the labor supply. The findings in the paper can be influential in rethinking the existing consensus about income effects and very valuable in the design of public policy. The next winner is Xian Ruane. Sean's paper is titled The Aggregate Importance of Intermediate Input Substitutability. Sean estimates the long-run elasticity of substitution between inputs at the plant level using Indian manufacturing data. They find that elasticity to be remarkably high, 4.3, despite the fact that every macroeconomist writes down models with elasticity is 1. Like in a Cobb-Douglas. That high elasticity implies that welfare gains from an increase in productivity in one sector is going to be quite large because factors can be substituted. Likewise, removing distortions or liberating trade also leads to larger gains than with the conventional Cobb-Douglas assumption. The paper combines detailed data to directly measure the right objects, a credible identification strategy to estimate the key elasticities, and a sensible model to extrapolate what they imply for policy and welfare. Last but not the least, Marta Santamaria. Marta has won the prize for the paper The Gains from Reshaping Infrastructure, the evidence from the division of Germany. In her paper, she takes an innovative approach to tackle a question of first-order importance, the economics of transport infrastructure. The paper develops a quantitative model of spatial equilibrium with cross-region trade and factor mobility, deriving within this framework an analytical characterization of endogenous infrastructure investment by an optimizing government. She's basically exploiting the way the plan for the transportation infrastructure in pre-war Germany. That involved a big road straight through Germany, which after the war ended up being a wall. She then, based on the pre-war plans, she estimated what would be the optimal network, which happens to pretty much coincide with the plan they had written. She then asked what would happen if there is a wall here, and given that suboptimal network, how should the rest of the network be constructed? And she finds that, well, that turns out to look pretty much like the German system in 1974. So she finds that being able to modify that framework, doing it in the optimal way, given the 1934 plan, gives efficiency gains of more than 1% of real GDP. That finding forcefully highlights the importance of transportation infrastructure and its planning. It showcases how theory, natural experiments, and quantitative estimation can be fruitfully combined to shed light on some of the key issues in economic growth. right. We have arrived at the main event of the day, the Schumpeter lecture. This year's winner of the Schumpeter lecture, this year's presenter of the Schumpeter lecture is Professor Veronica Guerrieri of University of Chicago. Veronica is a leading scholar whose work span many fields: macro, theory, labor. I had the pleasure and honor to work with, to be at the same place as her for a while at Minneapolis Fed. I really enjoyed that. Veronica is an incredibly hard worker and incredibly well organized. In fact, if I need to, in some cases I've needed to get in contact with Guido, I would send an email to Veronica, and immediately I get an answer from Guido. Veronica's work on financial frictions, liquidity traps, and flight to quality are major contributions to the literature, macro literature, and financial literature following the Great Recession. Her work on search and markets contributes significantly to our understanding of how markets work, especially labor markets. She also has done several contributions in other fields, including work on growth and structural change. Veronica has a number of editorial assignments. The most important one, perhaps, is her work as managing editor at the Review of Economic Studies. She has won a number of prizes, among them the Carlo Alberto Model of the Best Italian Economist Under 40. She has a PhD from MIT, and she's currently a Ronald Terrison Professor of Economics at Chicago Booth. Veronica, you, go ahead and tell us what you have to say.
So, thanks a lot, Kjetil, for the very nice introduction. It's a great pleasure to be here to give the Schumpeter lecture. And today I'm going to talk about household balance sheet and credit cycles. So, in the last 10 years, there has been a lot of research in macroeconomics to try to understand the Great Recession. And there has been a lot of progress, both on the methodological point of view and the substantial point of view. But there are two questions where there is no consensus answer yet. One is what are the main causes of the recession, and the other is why the recovery was so slow. Okay? So there has been lots of progress on both these areas of research, but economists still disagree on what is the main leading factors that led to the recession. In particular, I would say that there are two main explanations that have been floating around in the different academic papers. On the one hand, some economists tend to point mostly to the financial crisis and to disruption in the banking sector as the main cause of the recession. And on the other hand, there are other economists that mainly focus on the housing market and the boom and bust in housing prices as the main reason for the contraction. So I'm going to focus on the US, and here is a graph that shows GDP in the US since 2000 until today. The gray shaded areas, for those who are not macroeconomists, are the official recession according to the NBR. And the one in the middle is clearly the big Great Recession, where you can see there has been a substantial drop in real activity, but also a slow recovery after the end of the official end of the recession. So if you see the growth rate of GDP after the end of the recession has been much slower for a while relative to the growth rate before the beginning of the recession. And so this is what we refer to as slow recovery. Another picture that I want to show you that is tightly linked to this one, of course, is what happened to consumption, which is a large part of the GDP. So, of course, there is a tight link between the two. And consumption as GDP had a big drop during the recession and also a slow recovery. Okay? So the growth rate of consumption as well as the growth rate of output took a while, many years, before recovering the same level that was active before the recession. So in particular, I want to think about consumption in the Great Recession relatively to consumption in previous recession. Because one striking feature of this Great Recession, I would argue, was the particular drop in consumption, the fact that consumption was particularly hurt by the economic outlook. Okay? So here, to convince you of that, I'm going to compare the pattern of consumption. You can focus first on the left panel, consumption in the Great Recession, which is the yellow line, relatively to the path of consumption during previous recession in the post-war I'm referring to, of course, because the Great Depression was another event where consumption dropped substantially. And you can see that, so I normalized to 1 the level of consumption at the beginning of the recession for all these different episodes so that we can compare the deviation from the initial level of consumption across them. And you can see that the yellow line shows a particular drop, acute drop in consumption in the Great Recession relative to the others, but also a very a more persistent path of recovery. And the other two panels show some component of consumption. So in particular, non-durable goods and services, which are the two components of consumption that are typically less hit by the recession, because typically durable goods are the ones that are mostly hit during recession. And these graphs show you that even those components of consumption that in some recession actually were not impacted at all, were experienced a large drop and persistent drop during the Great Recession. So what is special about the Great Recession relatively to the previous recession? Why this particular drop in consumption and persistent drop in consumption relative to the previous post-war recession? So there are two main defining features of the US economy at the onset of the recession that make it special relatively to the previous one. And one was that there was a big financial crisis, and the other was that there was a particular situation in the housing market with a boom and bust in housing prices. Okay? So here are the two main leading explanations. One is there was a financial crisis originated by the collapse in the mortgage-backed security market and in related market. And this crisis generated a big disruption in the balance sheets of the banks that in turn generated a drop in lending to firms and households. And so this credit crunch can lead from a financial crisis to a contraction in demand for consumption and investment, and hence to a recession. Okay? So this is one explanation. The other one is focusing more on house prices and the fact that there was a big decline unexpected in house prices that possibly generated a wealth effect on consumption, on households' consumption, that generated a drop in consumption demand and hence a recession. Okay? And the other side of this drop in consumption generated by the house price drop is a wave of deleveraging in the households' balance sheets. So let me show you two pictures to highlight these two features of the economy. The first one is one of the many indicators of the financial crisis. In particular, this is the financial stress index of the St. Louis Fed. And you can see that there has been a peak during the Great Recession and then a sharp reduction right after the recession. Okay? The other one is house prices. And you can see that also here there has been a sharp increase, especially after 2000, in house prices, and then a drastic drop around 2005, 2006, before the recession. Okay? Now, Ben Bernanke, in his Brookings presentation last fall, was one of the more vocal advocates of the idea that financial disruption and actually so banks' panics were at the origin of the recession. And one of the argument that he proposed in favor of this idea is that if you look at house prices, the drop in house prices happened before the recession, so the timing is not very aligned, while if you go back to any financial distress index, you see that the timing is much more aligned with the Great Recession. Okay? So his argument was a timing argument. In response to this Brookings presentation, there has been lots of economists arguing the other way around, that the housing sector has been instead most important to generate the recession, and the most vocal that spill over to blogs and media were Paul Krugman and Dean Baker, and they actually argued that, well, it's true that the timing is much better, but any financial indicator shows a dramatic drop right after the recession. So it looks right after the end of the official recession, banks are back to a good state, and so it cannot explain the persistency of the recovery. If you look at house prices, they also recover pretty fast. But what these economists point to is the household's leverage. So the idea, the household, this is a picture of total liabilities of the household sector, and you can see that there has been an increase in 2000, following the similar pattern to the house price boom, and then a decline during the recession and then a recovery, but these patterns are much more slow moving. So both the deleveraging wave and the recovery have been much slower than both the house prices and the financial stress indicator. Okay? And so the idea is of Paul Krugman and Dean Baker is that the house price pattern, so the house price bust, generated a deleveraging in the housing sector that has been more slow moving, and this deleveraging has been the main cause of the Great Recession. I am going to focus also on households deleveraging today. The broader point that I'm going to give you with different pieces that compose the puzzle is that household leverage, I believe, is probably the most important feature of the Great Recession, but not necessarily linked to the housing market, also because of that, but also because leverage of American households made the economy more sensitive to any type of shocks. Okay? So in particular, I want to give you three main points to take home today after this lecture. First, the financial contraction that generated a credit crunch had a large effect on the real economy because the households were highly levered when the recession, the shock hit. Second, the house price drop also had a sizable impact on consumption for the same reason, exactly because households were highly levered when this shock hit as well. And third, the slow household deleveraging is what explained the sluggishness of the recovery. And so to think about the Great Recession, we need a model where not only we have also house price shock, but we have some rich structure of debt. And I'm going to give you some details of that later. Okay? So just to sum up with the diagram, the lecture of today, there are two main possible causes for the recession that have been emphasized by the literature. One is the financial crisis, and one is the housing bust. And I'm going to talk about them, talk about the channels through which these possible causes are going to generate a drop in real activity, and in particular, I'm gonna highlight how household leverage and households' balance sheet are important for this effect to be sizable. Now, there are things that I'm gonna leave aside from this lecture that I wanna though give you a brief overview. One is that, of course, these two causes are not isolated. There are clear interconnections and feedback effects between the housing price behavior and the financial markets. In particular, like housing bubble bust may have contributed to generate a financial disruption because of the collapse in the mortgage-backed security market. And on the other side, the financial crisis may have contributed to amplify the drop in housing demand that amplified the drop in house prices. There is a lot of work working on this interconnection. I have a handbook chapter with Harald Ulig where we talk a lot about several papers that have contributed to this side of the literature, but I'm not going to talk about this interconnection today. The other thing is that, of course, I'm talking about causes of the Great Recession, but what I really mean by that is proximate causes of the Great Recession. There are deeper causes behind the scenes that in turn generated the boom and bust in the house prices and the financial disruption. And there are many alternative stories about deep causes, and there is a lot of research on all of them. I'm going to cite just a few. One is thinking about the globalization and the sharp increase in demand for safe US assets, what has been labeled as saving glad. The other is the wave of financial deregulation that the US has experienced in the first 2000. And then there are the government housing policies that some have blamed as one of the causes of the increase in home ownership rates and so in debt of the households. Okay? So these are all interesting stories to think about. I'm not gonna focus on this today, but of course there is plenty of room for more research. There's been a lot already, but there is still open room for research on this dimension as well. So to give you a roadmap of what I'm gonna say in the rest of the lecture, first I'm gonna show you the channel, a model through which the credit crunch is gonna generate a recession and explain the link between that and households deleveraging. Second, I'm gonna talk about how the housing wealth effect and show you that actually house price drop can have sizable wealth effect on consumption. Third, I'm going to talk about the slow deleveraging and show which ingredients do we need in a model to think about these channels. So my research has been focused in building models to think about these different channels, and I'm going to use these models to give you the mechanism that I think are important to understand what happened. First of all, let me show you balance sheet of the households in 2006 at the onset of the recession. This is from the flow of funds in trillions. The numbers are in trillions of dollars. On the left-hand side, we have assets. On the right-hand side, we have liabilities. And you can see that one large component of the assets is real estate. And the biggest component of the liabilities is mortgages. But if you look at the net worth of the average American households, you see that it's positive and large, actually, like 62 trillion, roughly. So if you think about the effects of a credit crunch under the lens of a standard representative agent model, you would not go very far in terms of large impact. Because if all the households are the same and they have positive net worth and large net worth, they won't be affected much by a credit crunch. So in order to think about the credit crunch and the effect on the real economy, we have to think about the distribution of these assets and liabilities across individuals and across households. And the important thing is that in 2006, when the recession started, the households were very bimodal. There were some households that were holding only liabilities, and some households that were holding only assets, or mostly assets. Okay? And so this generates, if we think about that, we have to think, if we think about the US economy in 2006, we have to think about an economy where there is a sizable share of households who are highly levered. This is what I'm going to show you is going to be important for the effect of the credit crunch. So this part of the talk is based on my paper with Lorenzoni, and what we do in that paper is combine a model with heterogeneous agents and uninsurable income risk, a la Ayagari, Bewley, and Gaggett, with nominal rigidities, and to use this model to think about the effects of a credit crunch on the real activity. So there has been a big, vibrant recent literature that uses model of this type that combines heterogeneous agents with nominal rigidities. I believe our paper and the Hohen Reis were the first one to introduce this type of models. There has been a lot of interesting paper working on that to address different questions. So Hohen Reis were thinking about fiscal policy. McKay, Nakamura, and Stanson were addressing mostly for guidance. Kaplan, Moll, and Violante used these models to think about monetary policy. And Kaplan, Moll, and Violante also introduced a very useful language to think about this class of model, which is HANK, heterogeneous heterogeneous agents, New Keynesian models. Okay? And this is not meant to be an exhaustive list of literature. There is a lot of interesting papers, and I think this is the most exciting line of research in macro nowadays to think. What we do here is use this type of models to think about a credit crunch. Okay? And so how do we model a credit crunch? We're going to think that these households who face this uninsurable income risk face an exogenous borrowing limit. Okay? And we're going to think about an unexpected change, contraction in this borrowing limit as a credit crunch. What are the effects of that? Well, the effects of that are going to be, first of all, a drop in demand for consumption that generates also, at the same time, an increase in demand for saving. And so at the same time, we are going to get a recession and a pressure downward on the real interest rate that is going to translate in the model with nominal rigidities into liquidity trap. So what's the main mechanism? The main mechanism is based on precautionary savings. So precautionary savings together with household deleveraging is the main theme of this lecture. So what do I mean by that? So if households face uninsurable income risk, they are worried about bad scenarios where they're going to be hit by bad shocks. If they know that there is a tightening in the borrowing limit, some households are going to be directly affected by that, but there is a large portion of the households who are not at the credit limit today, but that they think that if they're going to be hit by a negative shock, they could be at the constraint, and so they're going to expect a higher future uncertainty. This means that they're going to do more precautionary savings to buffer themselves against this bad scenario. And this increase in precautionary savings is what generates the drop in demand for consumption and the drop in the interest rate. So let me give you the basic model. The preferences are standards. There are heterogeneous agents who consume and made a choice about the labor effort, and they have only one asset that is one short-term bond, B. So they are going to consume, choose their consumption, and how many bonds to buy. If B is negative, means that they are borrowing. What are the resources that they can use? They get some income, which is the real wage per efficiency unit, times the amount of work that they had to provide, times their productivity, theta. And this theta is the source of heterogeneity across households in this model. They are going to get some return from the bonds that they own, or they are going to have to pay some returns on the borrowing that they have decided to do, and then they have to pay some taxes. And then they face an exogenous borrowing limit, so they can borrow only up to a limit phi. So B can be negative, but not beyond phi, minus phi. Okay? So phi is the parameter that we are going to shock to think about a credit crunch. So when I'm going to talk about the credit crunch, we are going to assume that households are going to face an unexpected decrease in phi. Let me first close the model. So we are going to assume that the supply of bonds is given and that the government is going to choose the taxes to balance the budget. And then there is a bond market clearing, so the supply of bonds has to be equal to the demand that is endogenously determined and depends on the endogenous joint distribution of wealth and productivity. And then last, there is a nominal rigidity, and the way in which we model nominal rigidity in this model is simple, it's just fixed wages. This, in this model, means that the nominal interest rate is going to be equal to the real interest rate, and so the central bank is going to choose, we are going to assume that the central bank is going to choose an interest rate equal to the natural interest rate up to the zero lower bound. Okay? So here are the results of the main exercise that we do in this paper. So we are going to, as I mentioned before, assume that households are going to face an unexpected and permanent drop in phi. This is what we are going to impose in the model. And we are going to choose a drop in phi so that household debt is going to drop by 10% between steady states. As a result, what's happening is that the interest rate is going to go to zero. We are going to go into a liquidity trap, and we are going to have a large drop in consumption, a recession. Notice that you have a large drop in consumption, but it recovers pretty quickly. This is quarters, so it's a very quick recovery. Okay? So, but let's understand now. I'm going to go back to the adjustment path later. For now, I want to just focus on the drop in consumption. Why do we get a large drop in consumption? So what it is important for that is to think about the different households and their asset positions. So there are going to be two sets of households that are going to generate, they're going to be responsible for this large drop in consumption. As I was mentioning before, there are going to be some households that are at their borrowing limit before the shock, and when the shock hits, they just have to deleverage because they cannot borrow anymore as before. Okay, so there is going to be a mechanical effect coming from the households at the limit. But there is another large set of households who are not at the limit, but they are not too far from the borrowing constraint, so they're not very rich, and so they are worried about hitting the borrowing constraint in the future. This set of households is responsible also for the drop in consumption because they're going to increase their precautionary savings. Okay? And the important thing to generate a large aggregate response in consumption is that those households who are the ones that are going to reduce their consumption, so the ones that are at the credit limit or the ones that are not too far from the credit constraint, are the ones with the highest marginal propensity to consume. While the households that are rich enough have a small marginal propensity to consume, if anything, they may also decide to increase their consumption because of the general equilibrium effect that interest rate is going to drop. But they are not going to change much because they have a small marginal propensity to consume. Okay? So let me show you, just to fix ideas, another graph. So the red line here is the consumption, is a consumption policy for a given theta guy. And on the x-axis, I have is bond holdings. And you see that when there is a reduction in phi, this is the partial equilibrium effect, the consumption policy is going to shift to the right. So not only the guys that are at the constraint are going to be affected, but everybody is going to be affected by the change in phi. So the shift is going to determine the precautionary saving motive. Okay? Now, importantly, the ones who are closer to zero are the ones where the function is mostly concave. So they are the ones with the highest marginal propensity to consume, and so they are ones that are going to respond the most to the shift. The ones that are rich are in the linear part of the consumption function, so they're going to change their consumption just a tiny bit, and when the interest rate is going to increase, they may actually go the other way. So in fact, let me show you what happened to their demand of consumption of the different wealth brackets. So the blue line in our exercise. The blue line is the first percentile of the wealth distribution, and you see the largest drop in them. And as you go up, you get a highest percentile. In fact, the 50th percentile is going to actually have a small increase in consumption. But overall, because these are the guys with the highest marginal propensity to consume, in terms of the aggregate, we are going to have a large drop. It is comforting that if you look at the data, and this is a graph taken by a paper by Heathcote and Perry, the poor seem to respond the most in the Great Recession in terms of consumption rate relatively to the rich, which is consistent with our story. So what do I want you to take out from this is that a credit crunch, to have a large effect, has to hit the economy in a situation where there is a sizable share of households who have a high marginal propensity to consume, so who are typically highly leveraged, and so they're going to be responsible for a larger response in consumption. Okay? Now, let's move on to the second cause I've talked about, so the housing market and the drop in house prices. So can a drop in house prices have sizable effect on consumption and then on the recession? There is a huge empirical literature trying to assess what is the consumption response to house price changes, and here I cite just a few. The traditional view in modeling, from the modeling perspective, is that instead standard models cannot generate large housing wealth effects. So what we did in a paper with Berger, Lorenzoni, and Vavra is to study the wealth effect of a house price change in incomplete market models with heterogeneous agents, uninsurable income risk, and housing. So similar to the one I've just shown you, but adding housing into the picture and see what happened. And I'm going to show you that this can generate large effects, again, exactly because it is important that we are going to have lots of households that are going to be levered and are going to be in debt to get big houses. So let me show you the simplest version of this class of models that we talked about in the paper. So this is a small deviation from what we had before. Households still enjoy consumption. Now they also enjoy housing services, and we are going to abstract from the labor supply decision to simplify things. So we're going to assume that output is exogenous and idiosyncratic. Again, this is the source of heterogeneity. So now the households have two assets, have the short-term debt and the housing. Okay? So the budget constraint is enriched to include the housing. Households choose consumption, their bonds holdings, and their housing value. And they have the income that is exogenous. They have the return on their bonds or payment on debt. And they're going to have also in their net worth the undepreciated value of their house. Okay? So it's important in this model, it's very simple. So I'm going to call it the liquid model of housing. Housing is perfectly liquid. There are no adjustment costs. And you can borrow short term to buy houses, okay? There is no long-term debt here. And this is the collateral constraint. Similar to before, there is an exogenous borrowing constraint, but now I'm going to let the household to collateralize their debt with the houses, so the borrowing limit is going to depend on the value of the houses. So with this simple model, we can get an analytical result that is that the individual response of consumption to a permanent change in prices can be written as the product of the marginal propensity to consume of the individual times the value of the house, his value of housing. And so there are two key assumptions to get this result. One is that we have liquid housing wealth, as I said before, no adjustment cost. And the other is that we choose a specific combination of a special utility form. So Cobb-Douglas between consumption to aggregate consumption and housing services, and CRRA for intertemporal utility. And with these two results, we get this result exactly. So then these results tell us that the aggregate response of consumption is going to depend on the joint distribution of marginal propensity, of marginal propensity to consume and housing holdings. And it is important to notice that the marginal propensity to consume is endogenous. And in fact, is an endogenous object in this model, and in fact, it depends on the debt. So the implication is that the aggregate consumption response depends on the joint distribution of housing and debt. Okay? And let me be clear here, this is a partial, I forgot to mention, it's a partial equilibrium exercise, so we are going to take, differently from before, we're going to take the interest rate, the house prices as given, and the income as well. Okay? So now, why is that we get this effect, this result? So let me illustrate the fact that the marginal propensity to consume and housing matters for the size of the effect of consumption. Here we have, again, the consumption policy as a function of net worth. So the individual net worth depends on the bonds, the short-term debt or assets, depending if it's positive or negative, and the housing value. Okay? So consider two households with the same house size and quality and the same age, but one has a low debt and one has high debt. So let's start with the one with low debt. So a high net worth, say a net worth of 0.35. This household, if it's hit by a reduction in the house prices, is going to shift to the left, so it's going to consume less because the net worth is reduced by the decrease in prices, but the response of consumption is very small because, again, the marginal propensity to consume of this household is small. If you take a household with the same houses, the same age, that is hit by the same price shock, but has instead high debt to start with, so a negative B, so it starts much more on the left of the net worth spectrum, well, then the same shock is going to generate a much bigger response in consumption because this household is on the concave part of the consumption function as a high marginal propensity to consume. So as before, if we have lots, it is important to determine what is the aggregate response of consumption to think about the distribution of households along this dimension of net worth joined with housing. So in fact, I'm going to show you how these affect the distribution of the response of consumption according to their wealth. Okay? What we did in the paper is enrich this class of models with a number of ingredients to make it more realistic. So in particular, we introduce a life cycle component. We introduce adjustment costs. So if you sell a house and buy another one, you have to pay a cost, maybe related to the realtor that you use, maybe related to moving cost. You have a refinancing cost, possibly, if you still have a mortgage when you sell a house and you have to refinance to get a new mortgage. We have a potential rental option. So if you are poor enough, you may decide not to buy, but just to rent. And then we introduce a simple version in this paper of long-term mortgages just to account for the fact that maybe you are not forced to deliver it right away because you have long-term debt, and so it was going to take a while before you have to pay back if you want. So with this richer model, we obtain two results. One is that the aggregate response of consumption to a house price shock is sizable. And in fact, we get a 0.23 on average in the population for the calibrated version of the model, which is a number that is close to the empirical result by Mian, Rao, and Sufi, which is one of the estimates that is most up to date in the literature. And the other result is that the consumption response to house prices is actually, even in this complex version of the model, once we calibrate it to the US economy, it is well approximated by the simple formula that I gave you before. So let me show you the results. So this is the elasticity of consumption to a house price permanent change looking per income bin. Okay? The blue line is the effective elasticity. The red dashed line is our formula. So first, I want you can see that our formula is pretty close to the effective elasticity. And that's useful because I can use it to interpret where these results, the size of the result is coming from. So for example, we cut it in the paper by different things, life, age, income being, etc. Here I'm going to show you by income being. And what you can see here is that at the beginning, when people are very poor, you're not going to have a large elasticity. Why? Because remember, we have a rental option here. So if you're really poor, you probably decide to rent. So you're not much affected by the house prices. But once you become a little less poor, not very rich, but a little better, then you may decide to buy a house, to take a mortgage and buy a house. So at that point, those households here are the ones that mostly respond to the shock because they are going to own a house and also own a large debt. So they are the ones with the highest marginal propensity to consume, and so they are the ones that are going to respond a lot to a house price change. Once we go higher on the income being, well, these households maybe have repaid the mortgage already, and they may have actually positive net worth. So even though they may own a large house, they have probably a low marginal propensity to consume, and so they respond less. Okay? So it is the joint distribution of house holding and debt holdings that generate the response of consumption to house prices, and to obtain, and why do we obtain a sizable response on aggregate? Because we have a good amount of households in this part of the distribution. Okay. This paper focuses on the impact response of consumption to house price changes, but as I was saying at the beginning, we are also interested in the dynamics because we want to be able to think about the length of the recovery. And so let me do a simple exercise here where I'm going to use the liquid housing simple housing model I showed you before with no adjustment cost and short-term debt, and think about a boom-bust in house prices. Okay? And so feed in the pattern of house prices in the data into this model and see what the model tells me in terms of consumption. Before doing so, I have to do a slight modification to the model, because if I just assume rational expectations, what the model would deliver is that during the boom of the house prices, the demand for houses will go down and the demand for debt will go down, which we know is counterfactual. So then why or what do we do to obtain the large increase in leverage and in housing holding that we see in the data? We assume that expectations of future house price appreciation increase as house prices increase as well. So if we do that, what do we get is, this is house price pattern in the data. We feed into the model and we get this pattern for consumption and for household debt. So first I want you to notice one point that we made in the previous paper, which is that if we look at the pattern of consumption, the dashed red line is the pattern of consumption in response to the same bust without the boom, so starting from the steady state distribution as if there was no boom before. So households are going to be much less levered, and the response of consumption is much smaller. So the leverage in the household sector that is coming from this increase in house prices is gonna, that we see here, is gonna be important to generate the large drop in consumption that we obtain in these simulations. Okay? But the other thing I want you to notice is that the recovery, again, is very fast, as in the previous paper, okay? Both for consumption and for household debt, okay? And so then we wonder, what is that generates this slow moving? So debt didn't go down so fast during the recession. It was much more slow moving. Consumption didn't go back up so fast. So what is that we're missing here? And so we have to think more deeply about debt contracts. And this is work in progress with some of the co-authors I mentioned. And what we do here, we introduce long-term contract and adjustment costs to reconcile these models also with the slow pattern of leverage and deleveraging and of consumption. So there is also here, there is a growing literature that study richer debt contracts and in models with heterogeneous agents. And this literature, though, has focused mostly on house price dynamics. There are important papers like Kaplan, Mittman, and Violante, or Greenwald. Here, our focus is on the implication of this rich debt structure on consumer spending and so on deleveraging. Okay, so let me show you a version of the model that I've shown you before, the liquid housing model, enriched in two dimensions. First of all, we have long-term mortgages, and I'm going to call them N. Second of all, we have adjustment cost, psi h, that are proportional to the housing that you own if you want to sell your house and or refinance. Okay? So the budget constraint is then going to be the following. Now, you choose your consumption, you choose your bond holdings, you have to you have to choose your mortgages, repay your mortgages, and then you have your housing. And what are the resources? You have some, again, exogenous income, your returns on debt net of mortgage payment, your value of housing, and if you decide to adjust, your cost of adjustment. So there are two scenarios. If chi is the adjustment decision is 0, then you're going to have to stay with the house that you had before, and you're going to pay a fixed mortgage payment rod that is constructed so that the mortgage is going to be paid in 30 years. If you decide to adjust, chi is going to be 1, you pay the cost of adjustment, but then you can re-optimize the housing, and this is going to be subject, you're going to take a new mortgage subject on the same collateral constraint that I showed you in the previous model. So what we get out of this model, so the dashed line here is the consumption response to a 10% drop in price in the liquid housing model, okay? Short-term debt, no adjustment cost. The solid blue line is the same consumption response to a 10% shock in price in a model with a long-term debt and adjustment cost. What I want you to focus on here, there are 3 things that I think are important. One is that, of course, the impact response of consumption is now smaller, because households are now in long-term debt contracts, so they do not have to repay right away, some of them that do not adjust. Second, that the path of consumption is much more persistent. That's, of course, for the same reason, because if some do not adjust right away, they're going to adjust along the line, and this generates some persistency in the process of consumption. But third, that is also important, is that it's true that the drop in consumption is not as large, but if you look at the accumulated losses in consumption, they're pretty much the same. So even with long-term contract and adjustment costs, you get a big response in consumption overall in the recession. So what's behind these dynamics? What is that generates this result? First of all, let me show you what happened with the red line in the same model where there are 0 adjustment costs, but there is long-term debt. So the introduction of long-term debt is already doing a lot in terms of creating this less impact response and slower response over time, okay, because people are going to be able to be locked in the long-term contract, and even if there is 0 adjustment cost, they may decide just to stay in the long-term contract, just not to have to repay right away in response to a shock. Okay, but what is important mostly for the size of the drop in consumption is actually the fact that there is a endogenous choice in adjustment. So to convince you of that, I'm showing you here the response of consumption in a model that is the same of the previous one, except so long-term debt and positive adjustment cost, but now it's like a Calvo version of the model. People adjust only if they're hit by a Poisson arrival rate. And we're going to choose the arrival rate so that the fraction of households that adjust at each point in time is the same as in the real model, okay, in the model with endogenous adjustment choice. So it's not about, this model is not that this smaller response does not come from the fact that there is less adjustment. The adjustment is the same. It's just that there are different people who adjust. And in the endogenous adjustment cost model, there is a selection of people who are going to adjust. And this is important to generate larger response of consumption for two reasons. One, who is going to choose to adjust? Well, some very rich maybe are going to choose to buy a bigger house, but they're not very important for consumption because, again, they have a small marginal propensity to consume. Most important, some very poor households, they may decide to adjust just because they need liquidity, so they want to cash back. Okay? So these are going to hit heavily by the price change because now they can cash much less than before. And so they're going to have a drop in consumption. Okay? The other important, so this is the selection effect. The other important thing that comes also from the selection effect is more an indirect effect, is the fact that there is a precautionary savings again. So there are households who are not going to adjust today, but they are close enough to their low net worth that to their limit, to their adjustment decision, that they fear the moment in which they're going to be hit by a bad shock, and they know that they're going to adjust when they're going to be hit by a bad shock. And so they know that prices will matter for them when they're going to adjust. And so they're going to, because they know that when they're going to be hit by a bad shock, they can liquidate less because now prices are lower, they're going to do more precautionary savings. Okay? And so this precautionary savings is going to contribute to this larger drop in consumption that we obtain. So to sum up the results of this work in progress, introducing long-term debt and adjustment cost generates three things. First of all, slows the response of consumption, which is good to think about the recovery. It reduces the impact response of consumption, but it makes it more persistent. Okay? And the third, what is important is that even though it reduces the drop in consumption, overall, the cumulative loss of consumption is not very different from the liquid housing model case. It's just that it's more distributed a long time. Okay? And key for this result is the selection that comes from the endogenous choice of adjustment. So concluding, what is my view on the Great Recession? So my view is that both the financial crisis and the housing boom and bust cycle have contributed to the drop in consumer spending and hence to the recession. That probably it is true that the financial crisis can explain more the acute phase of the recession, while the housing bubble bust is more behind the slow pattern of recovery. But what I wanted to emphasize with my work is that households, the high leverage of households is very important to explain the size, the magnitude of the effect of both these channels. Okay? Both the financial crisis and the house price bust generates larger responses in consumption and in real output because of the distribution of assets and debt at the beginning of the recession, because many households were highly levered and had a high marginal propensity to consume. Okay? And then finally, that to explain the length of the recovery, we need to generate a slow deleveraging of households. So in order to do so, we need to enrich our models with a richer debt structure. Okay. Thank you.
Thank you very much for an excellent lecture. We have time for some questions. Let me abuse my role as chairman and ask the first one. So imagine you get a phone call from George Bush or Clinton for that sake. Let's say it's 15 years ago, and he asks you, how should financial regulation be done How should macroprudential policy be done? Imagine we buy your premise. What is the right response?
So, I mean, as you said, I think that clearly macroprudential regulation is the way to go here, much better than acting after the damage is done. It is hard, though, to anticipate how the market are going to be creative in the way of getting around the regulation. So I imagine that it's very hard to answer this question once for all. At the time ex post, probably controlling the leverage of the limit the possibility of leverage of the banks and would have been probably the best way to go, because if the banks were less leveraged, then they would have they would have been hit less by the crisis, and they would have contracted less their lending to the households. Maybe also some regulation on the housing type of debt, like subprime mortgage, and so would have been appropriated.
Yes.
In your model, when the value of your house goes below the mortgage, the consumers bite the bullet and they reduce consumption. I mean, the budget constraint is always satisfied, if I understood correctly. I think that this is going to enhance the precautionary motive, because, of course, with a CRRA specification, consumption going to zero means utility going to minus infinity. I wonder if you could sort of enrich the model and allow this option that you have in the US of these no-recourse mortgages, where you hand in the keys and then the debt disappears.
Yeah, so of course we simplify the model by not having default in our papers. It would be very interesting to embed these episodes in the possibility of default in the model. We haven't done so. It's a great way to go. I mean, there is some research that shows that there was no large fraction hit by, I mean, the contribution of the households who actually defaulted to the drop in consumption was not so large, but it's true that this may have an effect on the precautionary motive that we are not well taken. That would be great future work.
Other questions? There's a hand up there.
Okay, so here you focus on
Who is that? Oh.
So you focus on collateral constraint here.
Sorry, on collateral.
You focus on collateral constraint. So is it a possibility also to look at the PTI, because it seems to be an important role in terms of consumption impact on. So it's something that how you could change in this model. Thanks.
Yes, absolutely. There is some, actually the paper by Greenwald that I cite introduced PTI, and it's an important channel that we are abstracting from here, and that would probably amplify the effect, but we haven't worked it out. Yeah, payment to income. So we impose a constraint that depends on the loan-to-value ratio. Instead, there is also another type of constraint that you could think about. Your payment is be proportional to your income. So that also a constraint that is binding. And there is work that shows that this constraint has an important effect on house price behavior, and it would be interesting to introduce these in models with consumption.
We have time for a little more. There's a question there.
Thank you. I think one of the really interesting things about the Great Recession was how similar recessions, deep recessions with slow consumption responses or recoveries thereafter, were seen across a large number of different countries. But these all had different, say, housing market structures and different housing finance structures. So how much do you think these results are applicable to other countries around the world that didn't necessarily have the same housing market institutions?
Well, I mean, I think that I hope that these results are broader than thinking about the US economy. So there are some countries, but of course it's very, I mean, the different countries may have different factors that can generate a slow recovery for different reasons. So there are some countries, even in Europe, like for example Ireland, that I believe are closer to the US in terms of characteristics. There are other countries where other factors came to place, and in particular in Europe there was also a second wave of a recession due to the sovereign debt crisis. So I think that would be another channel to exploit to think about the response of consumption.
All right. Time is up. Veronica, I'd like to thank you for delivering a great message.